This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. It is not intended to cause or induce breach of an existing agency agreement.
Okay, so we're here with Andrew Ramlo, VP of Advisory Services, and Ryan Berlin, Director of Intelligence and Senior Economist at Rennie. How are you both doing?
Well,
Yeah.
doing well. I'm just generally fatigued.
It's been busy. Yeah,
Go on. You're fatigued?
Well, 2 kids.
Yeah.
Full days.
Nice.
So
Sounds like Adam.
How old are your kids?
they're 8 and 10.
8 and 10. Okay, you're ahead of me, but I've got a 1-year-old and a 4-year-old.
Oh, you're in deep. Yeah,
I'm in deep right now. Yeah.
And I have an 11-year-old, so I'm like smooth sailing.
It's a good age.
But just wait till you hit 14, 15.
You know what? She's actually it's a girl, and I feel like she's almost there. Like every day, I'm like, she's either like kittens, like she's. I'm like, what are you, 6? And then the next minute, I'm like, what are you, 22?
Yeah.
Like, there's the swings are crazy, but.
Welcome back to the Complaining Dads podcast. Well, thanks for taking the time today. I'm trying to remember the last time you were on was just before COVID, I think, around late 2019, if I remember, which was a totally different world.
Or was
fair.
it?
It was almost boring.
Yeah. And now we're super happy to have you back. It's been in the making for a bit here. Can we start maybe with Andrew? Can you tell us a little bit about yourself?
So I've got a background in urban economic geography and a master's in planning, and I've been working in real estate, dabbling in real estate for the last 20 years. But in terms of my role at Rennie on the advisory services side, we work for the municipalities as well. We work for a lot of developers, but then also work for some of the ministries, Ministry of Housing, and then up to the federal level as well. So a little bit of a wide and diverse runway in terms of who we serve, but then also the range of issues that we look at. It's broader than just real estate.
So just so I understand your services at Rennie, so you're providing intelligence for the development community, for the general population with your podcast, your reports, but then you're also working, consulting for government, municipalities. Wow,
Yeah,
that's interesting.
So when years ago, like Ryan and I have been working together for probably about the last 20 years now, and we used to run a consulting firm called Urban Futures before we moved over to Rennie about 8 years ago now. And when we moved over, we established the intelligence team at Rennie. And Ryan, you guys have grown into how many folks now in intelligence?
Yeah, we're 6 people.
Yeah, 6. And then about just after COVID started, we decided to hive off advisory services. And so I moved over and run advisory services, and Rye stick handles the intelligence team.
Nice. Well, that's a good segue to Ryan. Can you tell us a little bit about yourself and your role?
Well, yeah. So as Andy said, we've been working together for a couple of decades now, which is crazy to me.
Yeah.
But so I head up our intel function, as Andy said, and so we've got a team with diverse skill sets, data analysts, and sort of quasi data scientists, and then market analysts as well. And we just every day we're just looking to procure and synthesize data and develop it into a foundation of insights for whoever the audience is, right? So whether it is developers or we have a brokerage, we have 250 realtors that work at Rennie, so to help them understand how the market's changing, and then government, and then information that we just put out there for public consumption as well.
Right.
So that's speaking of segues to the next question. How's the market?
It's such a good question, right? I mean, it's like you can ask. It's so easy to ask, a little tougher to answer. I'll just say that where we're at right now, every every downturn, every point in the market is unique, right? It always is. So to say right now it's unique, yeah, it's always unique. But I think what makes this one particularly interesting, this particular downturn and cycle that we're in, is that really everything is about inflation. It's like one thing. We have such a dynamic and complex market, but really what's messing everything up is the high rate of inflation. So we care about inflation, of course, within the context of the housing market, because it has an impact on interest rates. And then interest rates in turn impact the housing market. Issues of affordability, whether you're a buyer or an existing owner. And it impacts the number of transactions that are occurring, right? On both the buy, you've got buyers right now who are really not able to afford what they want to be able to purchase, and then you have so they're not buying, many of them, and then you have sellers who are sort of looking at what their home value was 10 months ago and saying, if I can't get that for my home, I'm not selling, because many of them at this point don't have to. Right. So we just have like a very sticky market. It's like it's a game of chicken almost between buyers and sellers, and we're just not seeing a lot of movement at this point.
So I'd also add the broader implications there in terms of things like construction and additions to the housing stock. Inflation and interest rates have had a really, really big impact on that, and we're seeing a lot of developers push pause a lot, especially on the rental side of things, as the pro formas just aren't making sense anymore. And we've also seen some pretty significant push up in rents as well. So, but not to the degree that it's going to offset what the new lending rates are.
Right. So it sounds like basically what you're describing is things are kind of in a slow moving grind to a halt, or real slowdown. Are we seeing?
I wouldn't say halt. I'd say a grind down. But we also have to look at that in context. What have we been used to? And question has to be asked. Well, what is a normal market then?
Right.
And so yes, it's grinding slower, driven by interest rates, but I wouldn't say it's grinding to a halt.
One point to add to that is that when we look at the resale market, we're in a once in a decade slowdown in sales. So it's been prolonged. Like when we look at Metro Vancouver as a whole, we've been sub 3,000 transactions a month for 8 months. We haven't seen that for over 10 years. Right. So it is, I think everybody's just waiting for that other shoe to drop. Like the uncertainty is paralyzing it, whether you're, an individual buyer or seller, or you're a business looking to, contemplating investments in people or infrastructure or technology. Anybody who's looking to part with a big amount of money is kind of holding back, because there's still, we're sensing now that maybe this rate hike cycle on the part of the Bank of Canada is coming to an end. We think, but we don't know for certain. It seems like bond yields, even though over the past 10 years, they kind of been like the 5-year and 10-year yields moving in sync with each other, up, down, up, down, up, down, but all around 3%. So there's a little more stability in a sense there. They're not just there's not this unabated rise in those yields. And inflation's starting to come down. We'll talk, I'm sure, a lot more about that. But I think there's some green shoots, to use a term I don't love, but I think it's appropriate, that we're starting to see a bit of an evolution in the macroeconomic context that is maybe sort of enticing some people back in, but we're not, by no means are we back to sort of that, that 2019 market.
Right. And just thinking about where we're at, because it's March 14th, so we're start moving into the spring market. We're talking, so a few things: game of chicken, other shoe to drop, green shoots. where maybe even just in the last couple of weeks here, like, are we seeing inventories definitely increasing a little bit, although it's really low? I'm just wondering, how do you see the spring playing out?
So I will say, we track the market on a daily basis. So we're tallying sales, new listings, tracking inventory. Inventory is remarkably flat. Typically between Jan 1 and the end of March, so that first quarter, we see inventory rise by 30%, and it's up by a third of that.
Wow.
So inventory, even 2 weeks into March, we haven't seen much movement from the beginning of this month. And typically, as you said, this is the most, we're entering the most active period of the year, and we're not seeing that increase in inventory despite the low sales counts because new listings are down 60% versus last year. It is sort of, not to get too sort of behind the scenes here and technical, but when we look at our dashboard and map out the daily new listings from last year, and then we overlay the daily new listings this year, it's night and day. Like, so back to this point of people aren't listing their home if they don't have to. We do still have a strong labor market, right? People have a lot of savings. People who want to be working for the most part are working and earning an income. And despite rising interest costs, for some homeowners, the majority are still able to afford their home. So we're not seeing those distressed listings right now. So it's tough. My prediction is on the inventory front that we will see more listings going forward, especially with these higher interest rates. Sales are tracking. This is the one thing. Sales are tracking at about a month end of 3,600. So that'll break that streak of sub 3,000 that we've seen.
Do you see more inventory coming on with people that have higher mortgage rates triggering it, or is it a case of we need some good news for more inventory to come on?
I don't think the good news alone will do it, because unless the good news translates to a greater price appetite on the part of buyers, then I don't think sellers are going to that will be the thing that gets them to put their home on the market. But yeah, I do think that we need to watch the variable rate market. Variable rate mortgage market is in rough shape. So CIBC just published their latest earnings report. I think it was $52 billion out of $72 billion of variable rate mortgages. That book were interest-only payments with negatively amortizing loans. So that's a rough situation to be in, because when those homeowners renew, all of that, so they're paying only interest, fixed payments, and that extra increment that they're not paying of interest is going back into principal, and they're snapping back to their original amortization period when they renew. So their payments are going to go through the roof, and they haven't been paying down their balance. So in some ways, that is going to impact some homeowners. So I think we are going to see some listings that come through where maybe even the seller's not as price sensitive as they'd otherwise be, because the primary goal is really to get out from underneath that mortgage. So I think we'll see a little bit of that. I don't know if it will define the market though.
And do you think that had inventory crept up to typical levels, do you think we would have seen prices fall off?
Yeah, that's an interesting one, because on the one hand, you might say, well, listen, for the given amount of demand that's out there, more supply might have meant lower prices. But I think one of the things that is defining the sticky market is a lack of options for buyers. So I do think that there's quite a bit of pent-up demand. We know that most recently, more than a third of all listings have been on the market for 60 days. Last year, it was half of that.
Right.
So there's almost like and talking to our agents, you guys would know too. I mean, it seems like there's a profile of home. It doesn't matter if it's a condo or a house or whatever, but if it's livable, if it's, if it's reasonably priced, it's going to sell. But then there's like a big schwack of existing inventory right now that's just not moving. And it could be that the sellers are saying, hey, whatever it was worth back in May, that's the only price that I'm accepting, and I'll just let it sit here until the market comes back to me. But really, there's actually less inventory than there actually appears to be. And so I think buyers are just kind of like, I don't have options. So, it'll be interesting to see if we get this game of chicken situation again. You get a bit more inventory, a bit more options for the buyers. They come out of the woodwork, and we could see prices start to rebound.
We also have to look and recognize that there's been some implications of that situation and low inventory on the rental market, right? Population in the region is still growing. Population in the province is still growing. People still need to live somewhere, and we have seen some pretty significant increases in rents, rental rates as well. And part of that is probably driven by this lack of opportunity because of such a tight market on the ownership side.
So people not buying, moving, or remaining in the rental market, I guess, as opposed to,
or landing in the rental market when they may want to buy and they just don't have enough options. And the one thing about the rental market is it's relatively fluid, right? Generally speaking, and the degree that somebody moves out, whether they move up a price scale in the rental market or into ownership, that frees up a unit that then cascades its way down.
Right.
And that has also become sort of blocked up with a sub 1% vacancy rate on the rental side of things. And that's just pushing the rental rates up.
So just thinking, and I'd love to talk about rents further, but to stay on the, the real estate side of things, interest rates obviously are a defining feature. Inventory is a defining feature. What are the other factors influencing the market right now?
This is back to this
Or
idea.
are there?
Yeah, I mean, there's always a lot of factors always, but I think really what's driving things right now is it's this linear sequential inflation, interest rates, and prices equation or relationship, and with inventory then influencing things at the margin. So I think, if interest rates went back to like if you could do a 5-year fixed mortgage rate at 2.5% right now, the market would just be super active.
Yeah.
Right. So
I'm going to go back to Bill Clinton's 1992 run for the presidency. And at that point, he said, it's about the economy, stupid.
Yeah.
And while I agree, which is what you're talking about, interest rates and things of that nature, I'm going to flip it around and say it's about the people, stupid. The other factor that we need to recognize is that we just at the federal level upped our immigration targets within the next 2 years to 500,000 people coming into this country. So there is another factor as well. And this is where the conversation gets more broad from ownership real estate into real estate writ large, the rental side of things. And we are needing to accommodate more people, not just in the Lower Mainland, but across the country. And that's also our kids who are eventually going to move out of the house and new migrants and immigrants as well. So that would be the other factor. It's not just about the economy, it's about the people.
Can we maybe talk a little bit about immigration? And you put out some numbers, but generally speaking, that's the one thing that everybody seems to be talking about, even though we're in kind of a softer territory right now in the market. Can we talk about some of the trends in immigration?
Sure. Starting back in 2017, the federal government started to up their immigration target, historically from a 250,000 person a year up to 310, 340. We came through February of 2022, and they upped their targets again to hit 450. And then in November, came back and said, we're going to go farther and we're going to go bigger, and we're going to go by 2024, 500,000 people. So very significant. It's double what our historical norm is at a policy rate of about 250,000 a year. That also puts us at the top of all G20 countries in terms of our immigration rate. It's about a 1.4% immigration rate. So very significant. Objectives are to address our aging population. We all know that. That's what the objective is. It is a targeted program bringing in people who are younger than what the demography in Canada already is. And so it will have implications on the labor force in terms of adding people to that. But also that stage of the life cycle, your most typical immigrant coming in their early to mid 30s, it's also family and household formation stage of the life cycle. So there's a pretty significant housing implication to the immigration targets. And in the unintended consequence of the federal government trying to address our demographic challenge is the housing implication of that. And so I think, Rye and you guys as well are super interested in, okay, what's going to happen in the spring market here? I sort of look in, like, I'm a little bit of a longer picture guy, and within the next 5 to 7 years, I think housing markets through Canada are going to be significantly challenged just in terms of availability of homes to accommodate. Again, it's not just immigrants and migrants, it's our kids who are going to eventually move out of the house as well. And so just dealing with those issues in the next 5 to 7 years, I think, are going to be incredibly challenging.
One of the things that we actually, we talked about this before we went on air here about having Wendy Waters on the program recently. And one of her comments was that the median income of new permanent immigrants has jumped significantly in the past, call it 10 years, and that it's prime renter age. So do we see this as likely as a huge demand in the rental market, I would anticipate?
Yeah, and we've looked at the stats and provided a lot of stats to Wendy on this front as well. And yes, certainly in the short term, in terms of the immigrant population, also the migrant population, so just interprovincial migrants, people tend to land initially in the rental market. So it's about 80% in terms of people filling their census forms out, whether they be immigrants or interprovincial migrants saying, yeah, well, I'm in the rental market. But we do find that there is a transition eventually into the ownership side of things. Once people get established and establish their local communities, they do tend to transition into onto the rental side of things. But in the short term, definitely big rental implications.
And have you looked at how many? Because you hear a lot of numbers thrown around, but do we have a sense of how many of the new permanent immigrant population will settle in the Lower Mainland?
Yeah, so it's interesting. So I'll backtrack for a second because we have these permanent resident targets of, as Andy said, 500,000 by 2025. They're not all net new to Canada, and historically it was 70% were new and 30% were already here. What's interesting, the last couple of years, that ratio has flipped. So there are a lot more PR approvals being made to people who are applying from within Canada already. And so that PR story as it relates to growth is a little bit different, but it's then complemented by the fact that we just issued 1.2 million permits.
Record number.
A record number across Canada last year, which just I think the previous high was somewhere around 800,000 or 900,000. So it wasn't even close. And most of those people are net new, and many of them will become permanent residents. And so then now to answer your question a little more directly, we look at these big numbers for Canada and the unprecedented growth that we're expected to see through migration across the country, but it's our largest regional economies and markets, metropolitan areas that are going to be disproportionately impacted in a direct sense. Because, in Metro Vancouver, the international inflow is our share of Canada is about double our share of the population. Right. And so that's also true for places like Toronto. We also see it in Calgary and Edmonton to a little bit of a lesser degree. But then that has indirect impacts for other regional markets. Like if we look at Vancouver Island and we look at the interior here in BC, that has implications for domestic movers and then those housing markets vis-a-vis the needs of people who are leaving the Lower Mainland or whatever for more affordability or more availability. So there's this cascading effect, and I think it's just the impact of the need for people and need to support our labor force, and the impact on the housing market is just amplified in places like Metro Vancouver.
Can we talk about how you see this playing out? Because, like in my mind, we've had a lot of conversations with folks in the development community. They're like, "Yeah, we're hitting pause. Let's see how this plays out." I was curious to hear your guys' conversations with. You guys are talking to tons of people in that community all the time, but so. As you said, rental stock doesn't pencil out. A lot of people are not keen to bring pre-construction projects to the market. We see this huge inflow, like even on rents. Rents right now, say downtown or what, like it's like
One beds for 2,600.
26, 27. Like how does this?
Yeah.
So in 2-3 years, if we're not actually providing supply, and wages are not going up that fast, like how does this actually play out? Because like how much can I charge for my basement in 2 years? Because right now, no, but I mean realistically, it's like if you're a regular person, I'm like, how do you afford to live in my basement right now, let alone above ground? It seems like where's the breaking point, and what does that look like? Is there a breaking point? Do we just escalate in perpetuity, or do people start leaving in mass, or what happens here?
Well, that could certainly happen. I wouldn't say en masse, but people will be less likely to choose the Lower Mainland as a location to migrate to, or my kids will say I'm getting out of Dodge because it's too expensive.
Right.
But that has implications for the secondary markets throughout the province as well. And we've already seen that, people saying, like Victoria's pretty cool over there. Like, well, how about Kelowna?
Calgary.
And then there's the further afield going to Calgary, but then, you got to shovel snow in Calgary and but, and I'll go back to what I said earlier, the next 5 to 7 years, I think, given these longer term trajectories of population growth and change, it's going to be a very challenging time for the housing markets. And back to your question when we started out, what's the market or how's the market? And it really depends on who you are, right? So for somebody like a developer, yes, they're going to hit pause right now, but in the longer term, like it looks like a relatively good market in terms of being able to either sell product or rent stuff out that you're building. But if you're somebody trying to get into the market, it's not so great. It's going to be super challenging going forward. And on the supply side, last year, we've on a net side finished about 22,000 homes within the Lower Mainland. So that's net new. CMHC data net of demolitions. And that was down a little bit from about 25,000, which was the peak the year before. But if I look forward in terms of our models at the office, we're needing to add on a net side within the next 3 years about 35,000 annually. So we're almost 10,000 units, more than 10,000 units a year short.
But we've never done that.
No, we haven't. We have not. And we also have not accommodated the amount of population growth that we're expecting historically either. So this is where it becomes sort of super interesting. And I've had lots of conversations with David Eby in his current role, but then also in his previous role as Minister of Housing. And this is in large part some of the drivers behind policy changes that are happening at the provincial level in terms of housing targets for municipalities and just trying to facilitate the addition of housing, because he looks at the data as well and goes like, could be a scary situation.
So Andy, we've talked in the past about housing and specifically rental housing being an economic facilitator.
Yes.
Right. So at some point, your housing stock can be such that it isn't conducive to growing the local economy. And remember in the States, the concept of the brain drain? I don't feel like we talk about that anymore.
Right.
This idea that people were like high skilled individuals and doctors were leaving Canada for the States, right? There was a concern that we're just losing good people. And I think on a regional level, we could get to that point where you have people going, especially in this world of working remotely. It's like people are going to go to the lowest cost jurisdiction to set up shop, even if they're employers on the other side of the country. Now, not everyone can do that. But there's a segment of the population that will, and they probably are. Like the last quarter of demographic data at the provincial level showed BC for the first time in for the first time since 2015 or something. We lost on a net basis, BC did, people to Alberta. And Alberta overall gained 19,000 people at the end in the last quarter of last year on a net basis from all places in Canada. And I know they got this campaign of
come home to Alberta,
and they're trying to steal our people and all that. And I don't know if it's working or not, but
the data show that it's working because they've got a backflow. Yes.
And that was the largest net inflow on a quarterly basis for them in over 40 years. So there is like a bit of a reckoning there. That's the great thing about markets and economics is that there are these balancing mechanisms in a sense, right? So not that it's comfortable, and this is not a desired state, because you're going to have people making very uncomfortable and suboptimal decisions, right? People who grew up in a particular neighborhood who can't live there. Even Andy's kids, he won't even let them rent their his own basement.
Well, it's worth $3,000 a month now.
Exactly. His basement. They're off to Alberta, and he buys them a snow shovel for Christmas. So it's an uncertain future, but I mean, it all can't work in the way that it has been. There's going to be something's got to give in a sense. Yeah.
Do you see? This makes me think of we're at 8 months or 10 months of historic lows in terms of sales volume. Is this moment an opportunity for buyers, or are you thinking 6 months from now, 6 months before now? When is now a good time to buy?
It totally depends on what kind of a buyer you are, I think. I think, I've said to a few people, like if you can reasonably afford carrying a variable rate mortgage right now, you can, and you're willing to take that on for a few years, you probably can ride that down and be in a better position even 1 year out from now than you are now. But not everyone's going to be comfortable with that because there's quite a premium on the variable rates right now. I think if you're a cash buyer, there's obviously an opportunity cost to putting your money in one particular investment. But right now, what you're benefiting from as an investor is prices detached home benchmark prices are down close to 20% since their peak in the spring. Condo prices are down, actually not that much, 7%. The last 2 months, they've come back up, which is a whole other thing we can talk about. But basically what you're doing is you're buying homes at a discount without incurring the pain or confronting the pain of the higher financing costs, right? So I do think that there are opportunities there. And then if you're an investor, listen, the secondary rental market is super important in providing the right kind of housing to allow our region to grow. It's a relatively small proportion of the overall rental stock, but over the past decade, the secondary market, so the individually owned condos and those sorts of things, has accounted for like 80% of the net growth in overall rental availability, right? So it's important. And some people sort of poo-poo the investor, like, oh, you're just out to make a profit. But I mean, it's actually a very important source of rental supply. And so, yeah, there are some opportunities, but I think that, that first-time home buyer, if you don't have a grandparent or parents with equity they can tap or a bunch of savings they're willing to hand over before they move on to a different world, then you're stuck. You're just pinched. Like your maximum purchase price has gone down, and that's
so tough. Even if there's an opportunity right now, it's unattainable for a lot of people.
There's a total disconnect between what buyers can actually legitimately afford, especially with banks doing more due diligence, and what sellers are willing to accept. And again, unless there's a reason for sellers to be more flexible with their prices, i.e., it's really expensive to be in this home, whether it's an investor on a variable rate mortgage who's like, actually, I can't carry this anymore, or it is just a homeowner who's like, holy smokes, I just renewed and I just added like $1,000 or $2,000 to my monthly payment. I can't do it. If we're going to see some of that, and that might help, but right now it's ships passing in the night kind of thing.
What about if your grandma has a reverse mortgage? Can we talk about the generational wealth transfer?
Okay.
Well, we can.
And you influenced that reverse mortgage.
The reverse mortgages are super interesting because I think while we see a lot of ads for them, Benjamin Tall and the guy, they looked at their mortgage portfolio and they said that, so it was 30% in their mortgage portfolio, 30% of first-time buyers were getting help from mom and dad. On average, it was to the tune of $90,000 across the country. They also found that 10% of move-up buyers, I think the number's correct, were getting help from the bank of mom and dad as well. In the Lower Mainland here, I think his number was $320,000 on average. So not a large, not tons of people, but the ones that were getting transfers were significant.
Wow.
But what they also found was, and again, I'll have to double back and check the numbers, but I think it was under 3% of those funds that were being transferred were being done out of debt. It was all being done out of savings.
Interesting.
Huh.
Yeah.
So it's not the reverse mortgage.
It's not the reverse mortgage that is driving that transfer of equity. And our numbers are right, like drum roll. You want to give the most recent number for what our estimates are for mortgage free?
So yeah, in Metro Vancouver, well, first of all, this stat still astounds me, but 2 out of every 5 homeowners is mortgage free, right? And a lot of that is demographically influenced because you have a big chunk of owners who are baby boomers, so like 55 to 75 or older, who paid down their mortgage many years ago. But the value of mortgage-free equity in this region is $400 billion. And in the 75 plus population, it's 100 billion. Billion. This is billion. And so we actually looked at it over the past 10 years using census data. We looked at that 75 plus group who was mortgage free back then, and then and how many households there were in that age group in more recently. And over that period, that 10-year period, that group was releasing. So I'll clarify in a sec. That group was releasing $400 million of equity into the market every month, right? So that's like 12% of the Metro Vancouver's resale volume monthly. That's not an insignificant amount. So that's money that it could be through a reverse mortgage. We don't know the answer to this, but it's a combination of reverse mortgages, of people dying, right? People moving away. So that money doesn't necessarily all end up in Metro Vancouver. It could be going in all sorts of places. And actually it would have an outsized impact on markets like Victoria and Kelowna, to the extent that money is being used then to purchase there. Mm-hmm. So yeah, that is a source of it's part of that demand equation going forward. We know that number is going to go up over time as well because of the
demography.
Exactly.
So we look at the census, and if I go back 10 years in the census, there was about 100,000 seniors, 65 plus, that would have aged into the stage of the life cycle where they had potential to transfer. If I look at the 2021 census, it's almost 140,000 people in terms of aggregate who are going to move through that stage of the life cycle that they have that opportunity to transfer. So that post-World War II boom bulge, they're getting into the stage of the life cycle, and it's just going to grow in magnitude. And to the degree that the values continue to increase and get pushed up, it's a double impact. You've got the demographic and then the dollar value financial side of it as well.
And I know you're focused on obviously looking in the market in the Lower Mainland and BC, but and obviously BC can fit in a small corner of Ontario. But do we see similarities in Ontario? Have you ever considered like Toronto and?
Toronto's the same. It's the same, very similar demography in terms of the Toronto market, but given the scale of it, if we think our 400 billion is big, I can't remember what it is, but
at one point
we did it. We ran it. Like the number is it's mind blowing, just because of the scale of the Toronto market. It's so large in absolute number.
Yeah, it's probably close to $1 trillion if you just look at the size of the.
So we often talk about that generational wealth transfer as almost being unique to Vancouver, but it's not.
Well, the unique part is that our home values are high. So on like a per capita basis, we punch above our weight.
Right. Of course.
And we've also had very significant increase in the values, right? And so that's the two combining factors, the demography, but then also the price. Price has been way up.
And is this, this is an obvious point, but maybe I'll frame it as a question. Is this, you hear about the blood in the streets scenario in the real estate market, but this is the missing component to that kind of either wishful thinking or analytical framework. We talked before we went live about having an economist on from outside of BC, where using that 30% of your income is an affordable home, and based on that metric, we should be dropping 60% declines. But that's the missing kind of component in that analysis set of the blood in the streets type scenario.
I think it's part of it. It's undermined a little bit if values across the board are going down, because then that pool of equity to be deployed into the market is smaller.
Right.
Proportionally, maybe it's similar. But I think the whole blood in the streets scenario, as you say, who knows? I know in this market we've been talking. There's been documented talks of a crash since 1911.
1911. And prices are too high in 1911.
And I remember being on speaking tours 15 years ago, talking about the title of my presentation was "Is there a bubble in Vancouver?" kind of thing. And there were a lot of voices, very loud voices, sort of saying, "This isn't real. It's all going to come crashing down." And I guess if you say that long enough, maybe you have a good chance of getting it right.
20% near, in the single family market, we've seen these there's serious declines, but they're not anywhere near.
It actually doesn't improve affordability at all, because it's the declines in house prices for the increase in interest rates has not been enough. It's actually made housing more
right.
More
Right. It's
expensive,
even
which is
harder to
interesting.
carry it. Yeah.
But I look at a market and I say, going back to Andy and the demographics, is what, where is it likely that the bottom might fall out of a market sort of long term? It's where there isn't job growth and population growth. So show me a market where you have net declines in populations. Nobody wants to live there.
Mm-hmm.
Nobody's moving there. Or you have net outflows. That's a market where, and maybe it's because the economy's not dynamic enough, whatever. Well, that's a market that's at risk of long-term decline. I think if from a stability perspective, if you have continued job growth and income growth and population growth, you're going to see oscillations around a long-term trend, and that's what we're experiencing right now. But it's just hard for me to get my head around prices in Vancouver falling to that of Regina or Moncton.
Sure.
Right.
Equity is one, but I'm back to my wheelhouse. It's people. It's about the people, and we are in the Lower Mainland going to move into a situation in the coming decade like we moved through in the late 80s and early 90s, where the post-World War II boom in that 80s, 90s period moved out of the familial home and created homes of their own. They became of age. And we're going to move into that same situation in the coming decades. It's not going to be the post-World War II boom, 55 to 64 population that'll predominate. It's going to be the 25 to 34-year-old age group within the next decade in the prime household formation stages of the life cycle. And that's driven in part by immigration and migration to the Lower Mainland, but then back to our kids getting out of the house as well.
So, and are you're tracking the numbers on kind of the demographic shift?
100%. So we have, we start up at the national level and we feed into a national population model that we recognize the federal immigration targets. And this is an interesting point. We wrote a report about 15 years ago called The Perfect Storm, which looked at issues of aging population in Canada, implications on the labor force. And at that point, we had said, we have to increase immigration targets. And from that point, or even before that, we used to run a higher immigration number for our national models than StatsCan or BC Stats did. And it just so happened in 2017, they sort of dusted our report off and said, yeah, you guys were right, and we should start increasing immigration targets. And so we start up at that national level and then feed down through all of the provinces and then down into major metro regions in Canada as well. So yes, we track it on geography basis, on an age and sex specific basis, and then translate that into what potential housing demand is, given not just the scale of population growth, but the composition of those additions as well.
It's actually really interesting. I don't have the numbers here, but just if we turn off migration in our models, so we take our population today and we just age people, and some people have kids and some people die, we continue to generate increasing demand, net new demand for housing for something like 15 years, which is a fascinating concept because we always attribute the need for new housing to, well, because we're adding people. And yes, that's obviously true. But to Andy's point, you have kids that grow up and they go from not being the head of a household to being the head of a household. They need their own, while a big proportion of the older population is still in their home. Our life expectancies are increasing. Disability-free life expectancy is at an all-time high. So people are staying in their homes. So there's the stock of homes is there, but it's occupied as this next generation is aging into this housing formation stage.
There's another super fascinating one there too on the life expectancy side. Yes, life expectancy is increasing, but the gap between male and female life expectancy is narrowing.
Which makes sense. Yeah.
Which makes sense. Like either we're getting smarter or my wife is out doing some of the fun stuff that we typically do. But what that means,
She works in a mine.
Yeah, exactly. Yeah. At least anecdotally, the degree to which that elderly couple can stay together, what happens? They stay in their home. Right. It's from what we see, what we track through the data. It's like at a point of one of the spouses passing away, that's that big change in lifestyle and potentially the sale of the house.
And also, I was going to ask you about the impact of COVID on that, because at least anecdotally, I feel like speaking of our old man, he was like, "You're taking me out in a pine box. Like I'm not going into because we're looking at our grandma in lockdown." It's like, that's not as, it's never an appealing situation, but it's definitely less appealing after thinking about how how COVID played out.
Yeah.
Well, this was something that David Foote, he was an economist at the University of Toronto, wrote the book called Boom, Bust, and Echo, like back in the 1990s. And he said like around 2000, 2010, we'd see a big rout in the residential real estate market in Canada because of the boomers aging and they're all going to get into retirement homes and all this kind of stuff. And he didn't actually look at the data in terms of that propensity to move in that older stage. Every year you get older after the age of 35, your likelihood to move declines. So the numbers are like 75 to 80% of that older population on their census form indicated that they were still in the same house in 2021 that they were in 2016. So there is this big likelihood to stay, to your point, and I think COVID certainly pushed it in that direction in terms of wanting to stay at home if you can. I'm not going to the seniors' home.
Right.
But also you look at the healthcare system, and this is also the direction, generally speaking, that a lot of the healthcare systems are trying to move within, stay community-based, because they don't have the ability to service that older population within the healthcare system. So the degree to which they could do it at home, like that works on the demography side and on the healthcare side of things as well.
We promised you specifically, Andrew, that we would be finished within an hour. We're running at 50 minutes here. So I just want to move on to a question that hopefully both of, Matt and I have thought about a little bit, but what will the headline for the balance of 2023 be, do you think?
You want to start, Ray?
One headline.
One headline.
Wow.
8 words or less.
What's the fate of interest rates? That, like, ultimately, it's just that dynamic and that path. So, like, it's kind of interesting as sort of like data geeks, data files, whatever, who have always been interested in the monthly release of labor market data and CPI data and the Bank of Canada interest rate announcements, right? Where most people couldn't care less. It's not relevant. Now everybody's like, it's like
the jobs data.
Yeah, exactly. Yeah. Just don't ask a follow-up question.
Yeah, exactly.
But it's true. People are more aware of all of these things, and they have a sense for the fact that they matter and how they matter to their world vis-a-vis, interest rates and how those are moving. And I think, we talked about this at the outset of the podcast, just that it's interest rates that are going to sort of primarily ahead of anything else in the short term. Because it's things like demography and other factors long-term that drive the market. Yeah. That's the long-term trajectory piece. But if we're talking about where are we next month versus a month after, it's watch inflation and what decision does the Bank of Canada make? Because that will then also influence, most directly it influences the prime rate and variable rate mortgages and any interest rates on HELOCs, et cetera. But then it also does impact bond yields and then fixed mortgage rates as well. So to me, that is easily the number one thing.
Yeah, Ryan and I didn't talk about this beforehand, but I would say the same thing. The headline is going to be inflation falls back into the Bank of Canada's target range. And
by the end of so that's a positive.
By summer.
We're actually saying by April, May, June, we should be back in the target range.
Wow.
Do you think we see a cut in Q4?
Okay, well, this is right. I'll let Ryan answer, and then I'll follow up.
Just before the cut talk, so that's a fairly dramatic drop in.
Right, you want yeah. It's the math. It's the inertia of the math.
We call it the math path for inflation. So, for what it's worth, the Bank of Canada itself has announced that or made the statement in its past two rate announcements that it expects the rate of inflation to fall to 3% by summer. So that's our central bank who is pulling the lever on rates. What we looked at was the month-to-month inflationary pressures from the beginning of the first half of last year and the second half of last year. Totally different economic contexts. And I won't necessarily get into all the details now, but we expect that it is that context from the second half of 2022 that is more relevant and likely to play out in 2023, where there's less, prices aren't coming down. We're not talking about things becoming cheaper. We're talking about the rate at which they increase.
Becoming less. Yes.
Yeah. We're seeing a lot of those not everywhere, but for a whole bunch of reasons, we're seeing price pressures abate. And if they evolve on a month-to-month basis the way they kind of did in the second half of last year, it's the math of inflation that is going to result in it plummeting. It's already come down. We've predicted it each of the last 3 months. We went from 8.1% in the summer, we're at 5.9% now. And the inertia of it will push the rate to 2% by May. I'm not saying that is where it will be. If it isn't there, it's because there have been some unexpected
Other
or
factors.
dramatic factors influencing inflation. And anything can happen, right? I mean, we've got the SVB situation in the States, and
War in
other banks.
Ukraine, there could be a whole bunch of stuff.
COVID 2023. I don't know anything. I'm just saying, we don't know.
I've just talked to 2 people with COVID as a total aside. But anyway,
Don't worry, they're not in this room.
It's Matt and Adam. Or do we all have it? Is the prize.
So that's where the path for the math will go. But as Rai said, all kinds of stuff could happen that could push that trajectory off. Even China and reorientation, reflation of their economy as they came out of only January 7th in terms of their zero COVID policy. But then the next question is, okay, well, what is the Bank of Canada going to do? And Ryan and crew have a pretty...
Well, I'll just say this, that some people think that there's no cost to having high interest rates. And they say, listen, we just got to crush inflation. So if you're not sure, central bank, keep increasing rates. The problem is there is a very real cost to having high interest rates. It's starting to play out now, an impact on real people and households and businesses, where living becomes unaffordable and you have to make drastic changes to your life that you wouldn't make otherwise, like sell your home or move away or whatever. We know that the current central bank target rate is above what they call neutral. So in a normal, go back to 2019,
right.
The rate was still low then, but we're talking about in more normal conditions, probably 2.5% to 3% is where they want to be. We're at 4.5% now. And we haven't seen the full impacts of the rate increases to date play out. They're still to come for the next year. So there's a risk in overshooting, that it deteriorates labor market conditions, that people lose their jobs, lose their homes. So I think the bank is going to be looking for reasons to bring that rate back into a neutral place. And if the inflation data are demonstrating stability in prices within that target range for a period of time, I think you can expect a rate cut.
So I think this could be a 6-hour podcast based on how much we want to talk about more stuff, but we are out of time. How can people find out more about what you guys are up to at Rennie?
So, I mean, we have a website. You can go to rennie.com/intelligence, and there you can access information about what we do and all of our latest reports, whether it's monthly reports on the resale market, quarterly reports on pre-sale, our annual outlook report, or the Rennie Landscape, which is our sort of signature report that we publish twice a year that looks at all the factors that kind of impact our market.
And I've managed to carve out a little bit of real estate on the website for advisory services as well. So if anybody's interested in engaging advisory services or wants any more info about that, they can jump over to the advisory services page on rennie.com as well.
And I will say we subscribe. You guys put out fantastic
Oh,
data.
you're good men.
Waiting for the next art party invite. It's been a while.
It has. I haven't been invited either, for what it's been worth.
But yeah, thanks so much for coming down and your time, and we'll let you guys get back to what you do.
Thanks, gents.
Thanks, gents.
Appreciate it.